Nicolas Darvas. Who was Nicolas Darvas? He was a Hungarian dancer who left Hungary in 1943, um, and he launched a world tour together with his partner, who was his half sister. They traveled throughout the world. They had a contract to perform uh, dance for various parties, and this tour lasted a few years. During that time, he got a significant interest in a stock trading, and he, um, within a very short period of time, actually 18 months, was able to make about $2 million on the stock market at that time. In today's money, it's probably it would be around 20 million. It took him a while before he found his own method of trading. Um, he published a book in which he described in very great detail his methodology. People frequently associate Nicholas Darvas's method with so-called Darvas box. This presentation gonna be pointing out that Darvas box is just a small part of Nicholas Darvas' strategy. It's not the most important part. It's just a small pin in a big mechanism that Nicholas Darvas was able to implement. I've seen people on the internet claiming that Darvas box no longer working, and they make those claims based on backtesting. They take randomly stock that developed chart formations reminiscent of Darvas box, and they make tests of say 100 boxes back testing, and then they don't get any statistical edge, and that makes them claim that Darvas theory, Darvas box is no longer working. This type of backtesting is not relevant. I don't think you actually can backtest Darvas box, because Darvas method of trading is much more than just a Darvas box. Here we gonna go into deep details. What is it? What was it about? So Darvas method includes stock selection, trading strategy, that include the box theory, psychology playing a huge role, psychology including self-analysis and self-regulation, risk management, and elements of luck. Stock selection. A prospective stock candidate should demonstrate rapid increase in price to the new high, often after doubling in price within preceding few weeks or couple of months. So it's not just a stock that goes up and has uptrending. It gotta be a very strong momentum. Darvas was looking for extreme momentum where stock will fly high very quickly. And again, what we're saying here is that literally the increase will be like 100 or more percent within a few months. So he would watch this stock. He would not jump in yet. Also, he pay attention at volume. So the stock expected to exhibit significant increase in trading volume. That should co-occur with the price increase. Also, stock should belong to one of the leading market sectors. It's not just a random stock, it's a stock that belongs to the leading sector or one of the leading sectors. Also, It's the strongest leader among the leading stocks. So not just a leading sector, it's also a strongest leader. Stock should show and continues to show high relative strength, meaning that the stock has to show some independence, has to show actually a lot of independence from the rest of the stocks or the rest of the market. That's what is relative strength about. And then what he was looking for, that stock that met all these criteria. So stock had made a rapid upswing of 100 or more percent in price within a short period of time. And after that, stock takes a breather. And after that, stock forms a particular chart configuration that people now call Darvas box. We're going to go into details of that a little bit later. Continue looking at the stock selection. So besides as being a leading stock and the strongest and have a strongest relative strength, he also was looking for the stock that belongs to the industry of the future. The stock is connected to the innovation that would affect significantly how we live in the future. Well, nowadays in 2020, when we think about future, we think about artificial intelligence, AL, robots, cure of all diseases, new source of energy, self-driving cars, eternal batteries, etc. The industry that will affect the life of many, if not all, the way we live, and it's a typo here, the way we live and work. A new revolutionary product or technology. Remember Taser? Remember Taser? How fly high it was for what seemed to be a no reason, but that was the example. Stock of interest is making a new all-time high after jumping out on a high volume from a particular chart configuration, now called Darvas box. I have been stressing a few times the Darvas box is not just some sort of a wooden box. Darvas box is a chart configuration that reminds box. It's a curve. It's a picture that the stocks chart make that can be reminded as box. Now we call it Darvas box. And also the stock consistently showed an accelerated forward-looking earnings. Every time when they publish their earnings, they're bigger and they are higher than it was predicted by analysis. They are surprising. And prognosis every time when they come up with a publication is also forward-looking. The stock of interest would have limited downside movements, while the rest of the market movements were much more pronounced. Here again, we're talking about relative strength. So the stock that is prospective candidate for trade, the Darvas would choose, also had a limited downside. When the rest of the market starts sinking, that would be the chart. That stock of interest would not immediately start sinking as everybody else. all other stocks, it will be kind of reluctant to do that, or has very limited downside. It would sink a little less than the rest of the market. Why? Because the traders who hold this stock have a lot of belief in this stock. They have this belief that market bad times will pass and this particular stock will continue its movement. Also, the traders that were late to get into this stock, they were waiting for this moment when this stock gonna slow down so they can jump in on board. That's why this stock is gonna be not rushing to go downside with the rest of the market. It shows independence from the rest of the market. We call it a good relative strength. And this stock will resume its upward movement before the rest of the market recovers from downtrend. The rest of the market participants would not yet see the market recovery, but this stock already shows significant strength before everybody else. How did Darvas analyze general market? Well, he judged it by Dow Jones Industrial Average. If DJI was sinking, it was an indication that general market was sinking. Now we can use we can still use DJI, but to be more precise, we can use Standard & Poor's 500 companies, which are represented by SPY symbol. Now, finally, we come into description of Darvas box. So Darvas box, or box-like chart configuration. This is a chart configuration that reminds you of box. The essence of the Darvas box is a new base established after significant upswing of stock. We already talked about this is not a random stock. This is the stock that met all the criteria that we just described. The right type of stock candidate will be active inside a box and bouncing up and down within horizontal borders of the box. This is interesting momentum. Darvas was looking for the stock that not just was sitting or gradually moving up or down inside the box. He expected the stock to be active and bounce around within a certain limits. And again, we're stressing the same thing. It's not a random box, but a box that has been formed by a particular stock candidate that he was very, it's an important part. Darvas was very particular which stock he was watching, at which stock he was expecting to form box. The Darvas box formation indicated that stock's rise was not just a hype after stock pauses its climb. It doesn't fall down from its height, but just pauses as if preparing for further climb. So this is also a very important moment, because you can find a bunch of stocks that meet all the criteria we discussed. All the criteria, but they really don't stop and don't make clear formation that would look like a Darvas box. The problem with a stock like this is the entry, where you can find your entry, save entry. Because if stock goes up and doesn't stop. It's very hard to enter the stock safely because as fast as it goes, as fast as it can drop after you enter that. Once the stock climbs out of the box, it should demonstrate a high volume to be considered. So the exit from the Darvas box creates a pivot where you can stop your put your stop loss. Very important moment. Darvas was trading with a stop loss. Box for chart formation that reminded him a box, Darvas box, was useful not only to indicate a buying point and entrance point for the stock, but also was very useful to put a stop loss price. This is very, very, very important momentum because Darvas never traded without stop loss. That was his one of his very important criteria. Well, this picture illustrates idea how the stock chart look like. So we have let's say we have a stock climb that goes very, very fast, doubles in price within a very brief period of time. Then it stops. It's the summit of Mount Everest. Stops and forms camp where you can take a rest. It takes a breather here. Here you can enter that. And then it goes again and again stops. It takes a breather here. So potentially, if you were late to enter the first camp, first Darvas box, you can do it at the second. I wouldn't recommend it the fourth or fifth, but definitely you can do it. Definitely you can in the second. Then it goes again up and up, and takes a breath again, forming another camp. It stops here. Then again, and then it reaches the summit, after which stock faith is unknown. And you don't want to be inside a stock like here. You have to be very much in alert after you made a substantial amount of money climbing. You have to be on alert for potential abrupt downside. So hopefully you already summed up a lot of income before stock made a climax. Extremely important part of Darvas's success was psychology. That also underestimated, undervalued component. People who discuss Darvas and criticize his strategy and claiming that it's no longer working, they totally neglect the psychology of his method. That played a crucial role. As much as important, or maybe even more important, than stock selection. Darvas possessed an enhanced ability for situational awareness. Darvas had ability to quickly identify and correct his mistakes. This is extremely important. But people say, you fool me once, and it's your fault, and fool me twice, it's my fault. Most of the traders who are not successful in the market they tend to repeat the same mistakes all over again. They make a mistake, but they repeat it and repeat it and repeat it and until they blow their account. What Darvas seemed to able to do, he would identify his mistake and he would not repeat it. That's a very rare quality, because if you possess this type of quality, it's more than you need. It is rare. It's very hard because mistakes are usually deeply rooted in our unconscious and instincts, and we tend to repeat on the market same mistakes, not realizing. But Darvas, I don't know whether he would not repeat it twice or 3 times, but obviously he was able to identify his mistakes and stop repeating them quicker than most of the peers. Darvas kept records of all his transactions from very beginning to very end. It was very interesting to watch, to read his book. Darvas, for the first few years, I would say, he doesn't say exactly, but it looks like, according to his diary, at least first 3 years, he was not successful. He was not making money, and he was either losing money or he would make money and then he would lose them. Despite of that, he religiously recorded all his trades. And at some point, he started to record not just trades, but also he would put a record on the reason behind his buy and sell, as well as mistakes that he made. So it seems like it took him much less time to learn from his mistakes than it would usually take the average trader. It took Darvas between 3 and 4 years to finally find his winning strategy and being able to stick with it firmly. Darvas possessed an unusually high ability for self-observation and self-control and self-correction. That was also key of his success. It cannot be backtested. Sorry. All his personal qualities allowed him corrective changes when he moved back to New York City and started losing money. So interesting that most of his success occurred when he was away traveling all over the world, and he was making trades through contacting his stockbroker in New York City via either phone call or telegrams from various corners of the world. And the broker would airmail him a weekly edition of Barron's. So Darvas would read Barron's that was already probably a couple of weeks old. He would look into stock movements, and he would call his broker or send a telegram telling him what kind of stock to buy and sell and where to put a stop loss. Also, he expected the broker gonna be daily or almost daily sending him a telegram with the quotes of few stocks that Darvas requested. So at some point, after he was successful and already made $500,000, he completed his tour and he settled in New York City. He opened the office in Manhattan, and this office was, among other, in a building where there were other traders, in a room where there were other trading partners. And he quickly started losing money. Within a few weeks, he lost $100,000, 20% of his income. So again, because Darvas had unusual ability to self-analyze, he realized that when he was traveling, he did not have an exposure to small minute market movements. He was not aware of them, and that helped him to avoid unnecessary worries and unnecessary trades. But when he moved to Manhattan, he got exposed to everything what's going on in the market, all the conversation between traders, all the news, all the movements of a ticker tape, and that really made him incapable to trade his method. So he became like everybody else. He would take a huge amount of trades, pay huge amount of commission. He would react on every rumor. At the end, after a few weeks, he basically abandoned his strategy that proven to be very successful, and he lost 20% of his income. But unlike most of the other traders, he stopped doing that. He realized he actually took a break during which he went to Paris. He flew down to Paris just so he can distance himself from Wall Street. And he was walking in Paris, and he was thinking how he can stop doing what he's doing, which is a losing strategy, and how he can return back to his strategy. What he came up with is that he had to recreate the environment that helped him to be winning. So he had to artificially recreate. So before, he was in different parts of the world, he was isolated from information. So he decided that he's going to be in New York City, but he will isolate himself from any information. He will be as much as isolated as he was when he was traveling. So despite being next to the stock exchange, he would not look at the ticker. He would not talk to the other brokers. He would not talk to his stockbroker. He would send a telegram to the next building telling the broker to give him quotes or buy or sell these stocks. So he was recreating, and only after that he again became successful. So he realized that an exposure to the noise, or extra knowledge about stock, or micromanagement of your stock, micromanagement of your account, is actually a big no-no. It screws you up. But what distinguishes Darvas from others, that he corrected his action within a few weeks, and he corrected it for good, which is rare. For majority of the players, they would not be able to do that. Even if they realize that they are doing wrong, it's hard to believe that they would be able to change it. So, in summary, his strategy was that before executing his trade, he would monitor and analyze a prospective candidate for some time. He was watching a prospective stock's behavior, as well as sector's behavior and condition of general market. He was getting familiar with potential buy for a prolonged period of time before making decision to buy. Interesting, he would make a pilot buy first. He would buy a small amount. That allowed him to get familiar with the stock and get better feel of the stock's behavior. Actually, this is a separate topic here. What he pointed out in his book, that he found that each stock has a character. And he was able, after a while, he was able to predict almost how the stock going to be behaving. All his remarkable wins were the result of both successful stock selection and successful pyramiding the winners. Okay, here we go. Darvas made a large amount of money on stock market in a very quick period of time. In a matter of 18 months, he made $2 million. And it happened in 1950s, which would probably translate in at least $20 million in today's money. And he was amateur. He was not a professional trader. But besides all of what is mentioned above, it also was his strategy of pyramiding the winners. He would add to the winning position. And he would add a lot, actually. That's also a key issue that also cannot be tested back tested in a Darvas box. And again, Darvas religiously kept stop loss between 2 and 5%, never breaking his rule.